Question 1. Operational review demonstrates a significant and prolonged disruption in a key trading system, leading to a temporary halt in specific transaction processing for a particular asset class. While there are reports of general technological challenges across several financial institutions in the past quarter, the firm's internal IT audit has flagged unique configuration issues within its proprietary trading platform as a potential primary cause. The firm's risk management team is tasked with assessing the impact and determining the appropriate response. Which of the following approaches best aligns with the principles of effective risk management and regulatory compliance in this scenario? Option A. Immediately implement a broad, firm-wide IT security upgrade and communicate to clients that the disruption is due to industry-wide technological vulnerabilities, focusing on reassuring them about the firm's general resilience. Option B. Focus solely on the external reports of industry-wide technological challenges, allocating resources to address these general threats and deferring any in-depth analysis of the firm's internal systems until the broader industry issues are resolved. Option C. Assume the disruption is a temporary, isolated incident and monitor the situation passively, relying on the general market stability to resolve the issue without further internal investigation or client communication. Option D. Conduct a thorough internal investigation to pinpoint the exact cause of the trading system disruption, differentiating between potential firm-specific issues and broader industry trends, and develop a targeted remediation plan based on these findings. The correct answer is A. Immediately implement a broad, firm-wide IT security upgrade and communicate to clients that the disruption is due to industry-wide technological vulnerabilities, focusing on reassuring them about the firm's general resilience. Explanation. This scenario is professionally challenging because it requires a firm to distinguish between systemic risks that might affect the broader market or industry and idiosyncratic risks that are unique to the firm itself. Misclassifying these risks can lead to inappropriate risk mitigation strategies, potentially leaving the firm exposed to significant losses or misallocating valuable resources. The CRM analysis of risk exam emphasizes the importance of accurate risk identification and assessment, which is foundational to effective risk management and client protection. The correct approach involves a detailed, firm-specific analysis to identify the root cause of the operational disruption. This means investigating whether the issue stems from internal processes, technology, personnel, or specific business lines, rather than assuming it's a widespread industry problem. Regulatory frameworks, such as those governing financial services firms, often mandate robust internal controls and risk management systems that require firms to understand and manage their unique risk exposures. This approach aligns with the principle of prudent risk management, ensuring that resources are directed towards addressing the most pertinent threats to the firm's stability and its clients' interests. An incorrect approach would be to immediately attribute the operational disruption to a general industry-wide event without sufficient evidence. This fails to meet the regulatory expectation of conducting thorough due diligence and internal assessment. It could lead to a delayed or inadequate response to the actual firm-specific problem, potentially violating duties to manage risk effectively and protect client assets. Another incorrect approach would be to dismiss the event as a minor operational glitch without considering its potential systemic implications for the firm's operations or its clients. This overlooks the possibility that even seemingly small internal issues can escalate and have significant consequences, contravening the proactive risk management principles expected by regulators. Professionals should approach such situations by first acknowledging the operational disruption and then initiating a structured investigation. This investigation should aim to gather data and evidence to determine the nature and scope of the problem. The next step is to categorize the risk. Is it industry-wide, firm-specific, or a combination? This categorization should be based on objective analysis, not assumptions. Once categorized, appropriate risk mitigation and response strategies can be developed and implemented, ensuring compliance with all relevant regulatory requirements and ethical obligations to clients and the firm. Question 2. The efficiency study reveals that the current method for estimating probability of default (PD) for corporate clients is time-consuming. The study proposes two alternative approaches to expedite the process. 1. Exclusively using a 10-year historical average default rate for all clients in a specific industry, or 2. Applying a single, universally derived PD value across all clients, irrespective of their individual financial health or industry sector. As a risk analyst, which approach, if any, would you recommend, considering the need for accurate and compliant PD estimation? Option A. Recommend exclusively using a 10-year historical average default rate for all clients in a specific industry, as it is a statistically derived figure and more efficient. Option B. Recommend adopting the approach that provides the fastest calculation, as efficiency is the primary objective of the study. Option C. Recommend a blended approach that combines historical data with current economic indicators and client-specific qualitative factors, while ensuring the methodology is robust and compliant with regulatory guidelines. Option D. Recommend applying a single, universally derived PD value across all clients, as this offers the greatest efficiency and consistency. Correct answer is C. Recommend a blended approach that combines historical data with current economic indicators and client-specific qualitative factors, while ensuring the methodology is robust and compliant with regulatory guidelines. Explanation. This scenario is professionally challenging because it requires a financial analyst to balance the need for efficient risk assessment with the imperative of regulatory compliance and ethical conduct. The pressure to streamline processes can lead to the temptation to adopt shortcuts that, while appearing efficient, may compromise the accuracy and integrity of risk analysis, particularly in the estimation of probability of default, PD. Careful judgment is required to ensure that efficiency gains do not come at the expense of robust and compliant risk management practices. The correct approach involves using a combination of quantitative and qualitative factors, grounded in regulatory expectations for PD estimation. This approach acknowledges that while historical data and statistical models are crucial, they must be supplemented by expert judgment and an understanding of forward-looking economic conditions and client-specific factors. This ensures that the PD estimation is not only statistically sound, but also reflects the current and anticipated risk profile of the borrower, aligning with regulatory requirements for prudent risk management and accurate capital allocation. The regulatory framework, such as that governing the CRM analysis of risk exam, typically mandates a comprehensive approach to risk assessment that goes beyond simple historical data analysis. An incorrect approach that relies solely on historical default rates without considering current economic trends or client-specific changes is professionally unacceptable. This failure stems from a disregard for the dynamic nature of credit risk and a potential violation of regulatory principles that require forward-looking risk assessments. Such an approach can lead to an underestimation or overestimation of PD, resulting in mispriced credit, inadequate capital provisioning, and potential regulatory sanctions. Another incorrect approach that uses a simplified one-size-fits-all PD model for all clients, regardless of their industry, size, or financial health, is also professionally flawed. This ignores the fundamental principle that risk is client-specific. Regulatory bodies expect institutions to have risk assessment methodologies that are granular and tailored to the diverse risk profiles of their counterparties. A generic approach fails to capture unique risk drivers and can lead to systemic mispricing of risk across the portfolio. A third incorrect approach that prioritizes speed of calculation over the thoroughness of data validation and model review is ethically and regulatorily unsound. While efficiency is desirable, it should not compromise the integrity of the risk assessment process. Inadequate data validation can introduce errors into the PD estimation, and insufficient model review can allow for the perpetuation of flawed assumptions or biases. This approach risks producing unreliable PD estimates, which can have serious consequences for the firm's financial stability and regulatory standing. The professional decision-making process for similar situations should involve a systematic evaluation of proposed efficiency measures against regulatory requirements and ethical standards. This includes understanding the specific mandates of the CRM analysis of risk exam jurisdiction, assessing the potential impact of any proposed change on the accuracy and reliability of risk estimates, and seeking expert consultation when necessary. A commitment to transparency, accuracy, and compliance should guide all decisions related to risk assessment methodologies. Question 3. Operational review demonstrates that the credit risk modeling team is exploring the implementation of advanced machine learning techniques to enhance predictive accuracy. The team is considering three primary approaches: a deep neural network with multiple hidden layers, a support vector machine with a nonlinear kernel, and a random forest ensemble. The firm operates under a regulatory framework that mandates robust model validation, transparency, and fairness in credit decisions. Which of the following implementation strategies best aligns with these regulatory requirements? Option A. Utilize a random forest ensemble with a very large number of trees, assuming its inherent ensemble nature provides sufficient transparency for regulatory purposes. Option B. Deploy a support vector machine with a highly complex nonlinear kernel, prioritizing predictive accuracy above all else, with minimal focus on understanding the specific feature interactions. Option C. Implement a deep neural network without significant investment in explainability tools, relying on the model's high predictive power as justification for its use. Option D. Implement a deep neural network, but invest heavily in post-hoc explainability techniques like SHAP and LIME to understand model drivers and conduct rigorous bias testing. Correct answer is D. Implement a deep neural network, but invest heavily in post-hoc explainability techniques like SHAP and LIME to understand model drivers and conduct rigorous bias testing. Explanation. This scenario is professionally challenging because it requires a firm to balance the drive for innovation and efficiency in credit risk modeling with the stringent regulatory requirements for model validation, interpretability, and fairness. The firm is implementing advanced machine learning techniques, which, while powerful, can introduce complexities that make it difficult to satisfy these regulatory demands. The challenge lies in ensuring that the chosen machine learning approach, despite its technical sophistication, remains transparent, explainable, and free from bias, thereby meeting the expectations of regulators. The correct approach involves selecting a machine learning technique that, while advanced, offers a reasonable degree of interpretability and allows for robust validation. Neural networks, support vector machines, and random forests all have varying degrees of complexity and interpretability. A firm must choose an approach that can be adequately explained to stakeholders and regulators, and for which validation methodologies can be effectively applied. This includes understanding the drivers of the model's predictions and being able to demonstrate that the model is not unfairly discriminating against protected groups. Regulatory frameworks, such as those overseen by the relevant U.S. regulatory body, e.g., OCC, Federal Reserve, CFPB, depending on the exam's implied jurisdiction. Assuming U.S. for this example emphasize the need for models to be well documented, validated, and understood. The chosen method must allow for the identification and mitigation of potential biases, aligning with fair lending principles. An incorrect approach would be to prioritize the predictive power of a highly complex black box model without adequate mechanisms for interpretability or bias detection. For instance, deploying a deep neural network with millions of parameters without employing techniques like SHAP or LIME to explain its decisions would be a significant regulatory failure. This lack of transparency would violate requirements for model governance and validation, making it impossible to demonstrate compliance with fair lending laws or to effectively manage model risk. Similarly, using a support vector machine with a highly complex kernel without understanding the feature interactions it captures could lead to unexplainable outcomes and potential bias. A random forest, while generally more interpretable than deep neural networks, could still pose challenges if the number of trees is excessively large or if feature importance is not thoroughly analyzed, potentially masking underlying discriminatory patterns. These approaches fail because they do not provide the necessary visibility into the model's decision-making process, hindering effective validation and potentially leading to discriminatory outcomes, which are strictly prohibited. Professionals should adopt a decision-making process that begins with a thorough understanding of the regulatory landscape and the specific requirements for credit risk modeling. This involves evaluating potential machine learning techniques not only on their predictive accuracy, but also on their interpretability, explainability, and the feasibility of bias detection and mitigation. A risk-based approach should be employed, prioritizing methods that allow for robust validation and clear communication of model logic to both internal stakeholders and external regulators. The process should include a strong emphasis on model governance, documentation, and ongoing monitoring to ensure continued compliance and ethical operation. Question 4. Risk assessment procedures indicate that a financial analyst is evaluating the creditworthiness of a corporate borrower. The analyst has access to the borrower's financial statements and has utilized ratio analysis, cash flow analysis, and a proprietary credit scoring model. Which of the following approaches to synthesizing this quantitative information would best satisfy regulatory expectations for a comprehensive credit risk assessment? Option A, relying primarily on ratio analysis, as it provides a standardized and widely understood measure of financial health. Option B, conducting a comparative analysis of the insights derived from ratio analysis, cash flow analysis, and the credit scoring model to form an integrated view. Option C, focusing exclusively on the cash flow analysis, as it directly measures the ability to repay debt. Option D, prioritizing the results of the credit scoring model, as it is designed to provide a predictive risk score. Correct answer is D, prioritizing the results of the credit scoring model, as it is designed to provide a predictive risk score. Explanation: this scenario is professionally challenging because it requires a financial analyst to synthesize information from multiple quantitative credit analysis techniques to form a holistic view of a borrower's creditworthiness. The challenge lies in understanding the nuances and limitations of each method and how they interrelate, rather than relying on a single metric. Regulatory frameworks, such as those governing financial advice and risk management, mandate a thorough and well-reasoned assessment, preventing superficial or incomplete analysis. The correct approach involves a comparative analysis of ratio analysis, cash flow analysis, and credit scoring models, recognizing that each provides a different lens through which to view credit risk. Ratio analysis offers insights into a company's financial health and performance relative to its peers or historical data. Cash flow analysis focuses on the company's ability to generate sufficient cash to meet its obligations, which is often considered a more direct indicator of repayment capacity than accrual-based accounting. Credit scoring models provide a standardized, often predictive, assessment of credit risk based on statistical algorithms. A comparative approach allows the analyst to identify consistencies and discrepancies across these methods, leading to a more robust and defensible credit opinion. This aligns with regulatory expectations for due diligence and prudent risk management, ensuring that all relevant quantitative indicators are considered. An approach that solely relies on ratio analysis would be professionally deficient because it might overlook critical cash flow dynamics or the predictive power of established scoring models. While ratios are important, they are backward-looking and can be manipulated. Relying exclusively on cash flow analysis, while strong, might not capture the broader financial structure or the forward-looking predictive capabilities of credit scoring. A sole reliance on credit scoring models, without understanding the underlying financial statements and cash flows that inform those scores, would be a failure to conduct independent due diligence and could lead to misinterpretations if the model's assumptions do not perfectly align with the specific borrower's situation. Each of these singular approaches fails to provide the comprehensive, multifaceted view required for sound credit risk assessment, potentially violating principles of professional diligence and regulatory compliance. Professionals should approach such situations by first understanding the purpose and limitations of each quantitative tool. They should then apply these tools to the available data, critically evaluating the results from each. The next step is to compare and contrast the findings, seeking to reconcile any differences or understand the reasons for divergence. This comparative analysis should then inform a final, integrated credit assessment that considers the strengths and weaknesses of each method. This systematic and comparative process ensures a thorough, well-supported, and compliant credit risk evaluation. Question 5. Stakeholder feedback indicates a need to refine our firm's approach to analyzing the risk associated with complex credit derivatives, specifically credit default swaps, CDS, and collateralized debt obligations, CDO, when advising clients. Our current internal guidelines are perceived as potentially insufficient in capturing the full spectrum of risks. Which of the following approaches best aligns with the principles of robust risk analysis and regulatory compliance for such instruments? Option A. Focus primarily on the credit ratings of the entities referenced in the CDS and the issuers of the CDOs, assuming these ratings adequately reflect the overall risk profile. Option B. Rely on the historical performance data of similar instruments, assuming future performance will mirror past trends without in-depth analysis of current market conditions or structural changes. Option C. Conduct a thorough, documented risk assessment that analyzes the underlying assets of the CDOs, the triggers for CDS payouts, potential contagion effects, and the impact on the client's overall portfolio, ensuring alignment with regulatory expectations for product understanding and client suitability. Option D. Prioritize the potential for high yield and capital appreciation offered by these instruments, with a secondary consideration for risk management only if explicitly requested by the client. Correct answer is C. Conduct a thorough, documented risk assessment that analyzes the underlying assets of the CDOs, the triggers for CDS payouts, potential contagion effects, and the impact on the client's overall portfolio, ensuring alignment with regulatory expectations for product understanding and client suitability. Explanation: this scenario is professionally challenging because it requires a deep understanding of complex financial instruments like credit default swaps, CDS, and collateralized debt obligations, CDO, and the ability to apply regulatory principles to their analysis. The challenge lies in discerning the true risk profile of these instruments, which can be opaque, and ensuring that the analysis aligns with the firm's regulatory obligations and the client's best interests, particularly in the context of the CRM analysis of risk exams focus on risk assessment and client suitability. The correct approach involves a comprehensive and documented risk assessment of the CDS and CDOs, considering not only their direct credit risk, but also their potential for contagion and impact on the overall portfolio. This approach is right because it directly addresses the core mandate of the CRM analysis of risk exam, to analyze risk thoroughly and appropriately. Regulatory frameworks, such as those governing financial advice and risk management in the UK e.g. FCA Handbook Cobbs CISC, mandate that firms understand the products they offer and recommend, and that they conduct adequate due diligence to assess the risks involved. This includes understanding the underlying assets of CDOs and the credit events that trigger CDS payouts and how these might interact. A documented risk assessment ensures accountability and provides a clear audit trail, demonstrating compliance with principles of prudence and client protection. An incorrect approach that focuses solely on the perceived low probability of a credit event, without a deeper dive into the structural complexities of the CDOs or the potential for systemic risk amplified by CDS, fails to meet regulatory standards. This is a failure to conduct adequate risk assessment, potentially violating principles of due diligence and client suitability. It overlooks the interconnectedness of financial markets and the potential for black swan events, which regulators expect firms to consider. Another incorrect approach that prioritizes the potential for high returns without a commensurate focus on the downside risk, and the firm's capacity to manage that risk is also professionally unacceptable. This demonstrates a disregard for the principle of proportionality in risk management and could lead to recommendations that are unsuitable for clients or expose the firm to unacceptable levels of liability. Regulatory bodies emphasize a balanced view of risk and reward, and a failure to adequately assess and disclose downside risks is a significant ethical and regulatory breach. Finally, an approach that relies on the issuer's credit rating as the sole determinant of risk, without independently verifying the underlying collateral or understanding the potential for rating agency conflicts of interest, is insufficient. While credit ratings are a factor, they are not a substitute for independent risk analysis, especially for complex structured products. Regulatory expectations are for a more robust and nuanced understanding of risk, going beyond superficial indicators. The professional decision-making process for similar situations should involve a structured risk assessment framework. This includes 1. Identifying the specific risks associated with the financial instrument, e.g., credit risk, market risk, liquidity risk, operational risk, counterparty risk. 2. Quantifying and qualifying these risks, considering their potential impact and likelihood. 3. Documenting the assessment process and findings. 4. Evaluating the instrument's suitability for the client or firm based on risk appetite, investment objectives, and regulatory requirements. 5. Implementing appropriate risk mitigation strategies. 6. Regularly reviewing and updating the risk assessment. Question 6. The assessment process reveals that a proposed investment product includes a guarantee intended to mitigate credit risk. The guarantee is provided by a holding company that is a subsidiary of the product issuer, and its own credit rating is below investment grade. Which of the following best describes the impact of this guarantee on the product's risk profile from a regulatory CRM analysis perspective? Option A. The guarantee is a formal assurance that completely eliminates the credit risk associated with the product. Option B. The guarantee's impact on risk is negligible and does not require specific mention in client risk assessments. Option C. The guarantee offers minimal credit enhancement and may introduce additional counterparty risk, requiring careful consideration of the guarantor's financial stability. Option D. The guarantee provides significant credit enhancement, substantially reducing the overall risk for the client. The correct answer is D. The guarantee provides significant credit enhancement, substantially reducing the overall risk for the client. Explanation. This scenario is professionally challenging because it requires a deep understanding of how different types of guarantees impact the risk profile of a financial product, specifically in the context of regulatory requirements for CRM, client relationship management. Analysis of risk. The challenge lies in accurately assessing the credit enhancement provided by various guarantee structures and their implications for client suitability and disclosure, all within the strict confines of the specified regulatory framework. Professionals must exercise careful judgment to distinguish between nominal assurances and robust credit enhancements that genuinely mitigate risk for the client. The correct approach involves recognizing that a guarantee from a highly rated, independent third party, such as a sovereign government or a AAA-rated financial institution, provides a significant and verifiable credit enhancement. This type of guarantee directly reduces the credit risk associated with the underlying asset or issuer, making the product potentially more suitable for a wider range of clients, provided all other risk factors are also appropriately assessed and disclosed. Regulatory frameworks often emphasize the importance of clear disclosure regarding the nature and strength of any guarantees, ensuring clients understand the extent to which their investment is protected and the creditworthiness of the guarantor. This approach aligns with the regulatory duty to act in the client's best interest by providing accurate risk assessments and suitable product recommendations. An incorrect approach would be to treat a guarantee from a related party or an entity with a lower credit rating as equivalent to a strong, independent guarantee. Such guarantees offer limited or questionable credit enhancement and may even introduce additional risks, such as counterparty risk or conflicts of interest. Failing to differentiate between these types of guarantees and their respective risk mitigation capabilities constitutes a regulatory failure, as it leads to an inaccurate assessment of the product's risk profile. Ethically, this misrepresentation misleads clients about the true level of protection they are receiving. Another incorrect approach is to overlook the specific terms and conditions of a guarantee. Some guarantees may have exclusions, limitations, or be contingent on certain events, which can significantly diminish their effectiveness as credit enhancement. Ignoring these nuances and assuming a guarantee offers unconditional protection is a critical error. This leads to a flawed risk analysis and potentially unsuitable product recommendations, violating the principle of due diligence and client protection mandated by regulatory bodies. The professional decision-making process for similar situations should involve a systematic evaluation of all risk-mitigating features, including guarantees. This requires 1. Identifying the guarantor and assessing their creditworthiness independently. 2. Scrutinizing the guarantee's terms and conditions for any limitations or exclusions. 3. Understanding how the guarantee specifically addresses the identified risks of the product. 4. Clearly communicating the nature and limitations of the guarantee to the client as part of the overall risk disclosure. This structured approach ensures compliance with regulatory requirements and upholds ethical obligations to clients. Question 7. Benchmark analysis indicates that a client is considering an investment in a diversified portfolio of asset-backed securities (ABS) and mortgage-backed securities (MBS). Which of the following approaches would be most appropriate for a CRM analyst to employ in assessing the risk of these investments for the client, strictly adhering to the regulatory framework for the CRM analysis of risk exam? Option A. Rely primarily on the credit ratings assigned by major credit rating agencies to the ABS and MBS issuers. Option B. Analyze the cash flow waterfall and credit enhancement features of each ABS and MBS, considering the specific characteristics of the underlying asset pools and the tranche being considered. Option C. Evaluate the historical performance data of similar ABS and MBS issuances over the past decade, assuming current market conditions will mirror past trends. Option D. Treat all ABS and MBS as a single asset class with a standardized risk profile, applying a uniform risk assessment methodology across all such investments. The correct answer is B. Analyze the cash flow waterfall and credit enhancement features of each ABS and MBS, considering the specific characteristics of the underlying asset pools and the tranche being considered. Explanation. This scenario is professionally challenging because it requires a CRM analyst to navigate the complexities of securitization, specifically asset-backed securities (ABS) and mortgage-backed securities (MBS), while adhering strictly to the regulatory framework of the CRM analysis of risk exam. The challenge lies in identifying the most appropriate method for assessing the risk of these complex financial instruments, which often involve multiple underlying assets and tranches with varying risk profiles. A superficial understanding can lead to mispricing risk, inadequate client advice, and potential regulatory breaches. Careful judgment is required to select an approach that aligns with regulatory expectations for risk analysis and client suitability. The correct approach involves utilizing a methodology that explicitly accounts for the cash flow waterfall and the credit enhancement features inherent in ABS and MBS. This approach recognizes that the risk of different tranches within a securitization is not uniform and is heavily influenced by the order in which cash flows are distributed and the presence of mechanisms designed to absorb initial losses. Regulatory frameworks for risk analysis typically emphasize understanding the structure of these products to accurately assess their sensitivity to various risk factors, such as interest rate changes, prepayment speeds, and underlying asset defaults. This detailed structural analysis is crucial for providing clients with accurate risk assessments and ensuring that investment recommendations are suitable. An incorrect approach that focuses solely on the credit rating of the ABS or MBS issuer would be professionally unacceptable. This fails to acknowledge that the creditworthiness of the issuer may not fully reflect the risks associated with the specific tranches of the securitized product, especially in situations where the issuer is a special purpose vehicle, SPV, whose primary purpose is to hold the securitized assets. Regulatory guidelines often mandate a deeper dive into the structure and underlying assets rather than relying solely on external ratings, which can be backward-looking or may not capture all nuances of the securitization. Another incorrect approach that considers only the historical performance of similar ABS or MBS without accounting for the specific structural features and underlying asset pool of the security in question is also professionally flawed. Historical data can be a useful input, but it does not replace the need to understand the current structure, the specific characteristics of the underlying assets, e.g., loan-to-value ratios, borrower credit scores for MBS, and the impact of any structural changes or economic conditions that may differ from the historical period. Regulatory expectations demand a forward-looking and structure-aware risk assessment. Finally, an approach that treats all ABS and MBS as homogeneous products with a uniform risk profile, regardless of their underlying assets or tranche structure, is fundamentally incorrect. This oversimplification ignores the inherent diversity within the securitization market. Different underlying assets, e.g., auto loans, credit card receivables, residential mortgages, have distinct risk drivers, and the tranching structure creates vastly different risk-return profiles for investors. Regulatory bodies expect analysts to differentiate and analyze these products based on their specific characteristics. The professional decision-making process for similar situations should involve a systematic evaluation of the securitization structure, including the nature of the underlying assets, the cash flow distribution waterfall, the credit enhancement mechanisms, and the specific tranche being analyzed. This should be followed by an assessment of relevant risk factors and their potential impact on the security's performance. The chosen analytical approach must be robust enough to capture these complexities and align with the specific regulatory requirements for risk analysis and client suitability. Question 8. Governance review demonstrates that the firm's credit risk management framework relies heavily on Monte Carlo simulations to project potential credit losses. The risk analyst has generated a comprehensive set of simulation outputs, including detailed probability distributions of default, loss given default, and portfolio-level loss scenarios. When presenting these findings to the Executive Risk Committee, which of the following approaches best aligns with regulatory expectations for effective credit risk analysis and reporting? Option A. Presenting a summary of key risk metrics such as expected loss, VaR, and potential stress loss scenarios, along with a clear explanation of the underlying assumptions and limitations of the simulation. Option B. providing a detailed technical report outlining the specific algorithms, random number generation methods, and convergence criteria used in the Monte Carlo simulation. Option C, focusing exclusively on the worst-case loss scenarios generated by the simulation, regardless of their probability of occurrence, to highlight the maximum potential downside. Option D, presenting a single, aggregated expected loss figure derived from the simulation, without elaborating on the range of potential outcomes or the factors contributing to the variability. The correct answer is A, presenting a summary of key risk metrics such as expected loss, VaR, and potential stress loss scenarios, along with a clear explanation of the underlying assumptions and limitations of the simulation. Explanation: this scenario is professionally challenging because it requires a risk analyst to balance the technical sophistication of Monte Carlo simulation with the practical need for clear, actionable insights for senior management. The challenge lies in translating complex probabilistic outputs into understandable risk metrics that inform strategic decisions, while adhering to regulatory expectations for robust risk management. Careful judgment is required to select the most appropriate output and interpretation of the simulation results. The correct approach involves focusing on the key risk drivers and their potential impact on the firm's capital and profitability, as derived from the Monte Carlo simulation. This means presenting a range of potential outcomes, including expected losses and value at risk, VaR, or expected shortfall ease measures, and clearly articulating the assumptions and limitations of the model. This aligns with regulatory expectations for firms to understand and manage their credit risk exposures effectively, ensuring that risk reporting is both comprehensive and comprehensible to decision makers. The emphasis is on providing actionable insights that support prudent risk-taking and capital allocation. An incorrect approach that focuses solely on the technical details of the simulation, such as the number of iterations or specific statistical distributions used, fails to meet the core objective of risk management. This is a regulatory failure because it does not provide management with the necessary information to make informed decisions about risk appetite and mitigation strategies. Another incorrect approach that presents a single-point estimate of loss without acknowledging the inherent uncertainty and variability of credit events is also problematic. This is an ethical failure, as it can lead to a false sense of security and underestimation of potential losses, potentially exposing the firm to undue risk. A third incorrect approach that prioritizes the most extreme potential outcomes without considering their probability of occurrence can lead to overly conservative or alarmist decision-making, hindering efficient capital deployment. Professionals should adopt a decision-making framework that begins with understanding the audience and the purpose of the analysis. The output of a Monte Carlo simulation should be tailored to the needs of senior management, focusing on the implications for the firm's financial health and strategic objectives. This involves translating complex statistical outputs into clear, concise risk metrics and narratives that highlight key sensitivities and potential impacts. Regular dialogue with stakeholders to ensure the reporting meets their needs and expectations is also crucial. Question 9. Compliance review shows that a client, a mid-sized exporter of consumer goods, has expressed significant concern about the increasing volatility in their international markets, specifically mentioning the risk of both individual large buyers defaulting on payments and the broader possibility of widespread economic downturn leading to insolvencies across their customer base. The CRM is considering recommending a credit insurance policy. Which of the following approaches best aligns with the client's stated concerns and regulatory expectations for suitability? Option A. Recommend a comprehensive credit insurance policy that covers both specific buyer defaults and general insolvency risks. Option B. Recommend a single buyer credit insurance policy to cover the default risk of their largest and most critical customer. Option C. Recommend a complex structured credit derivative product designed for highly sophisticated financial institutions. Option D. Recommend a trade credit insurance policy that exclusively covers political risks associated with international trade. The correct answer is A. Recommend a comprehensive credit insurance policy that covers both specific buyer defaults and general insolvency risks. Explanation: this scenario is professionally challenging because it requires the CRM to distinguish between different types of credit insurance and their suitability for a client based on the client's specific risk profile and business operations, rather than simply offering a generic solution. CRM must demonstrate a nuanced understanding of how each policy type addresses distinct credit risks. The correct approach involves recommending a comprehensive credit insurance policy that covers both specific buyer defaults and general insolvency, aligning with the client's stated concern about a broad range of potential customer failures. This approach is justified by regulatory guidelines that mandate suitability and client-centric advice. Specifically, regulations emphasize that financial advice must be tailored to the client's circumstances, objectives, and risk tolerance. Offering a policy that addresses the client's articulated fears of both individual buyer non-payment and systemic market downturns demonstrates a thorough understanding of their needs and a commitment to providing a robust risk management solution, thereby fulfilling the CRM's duty of care. An incorrect approach would be to recommend a single buyer credit insurance policy solely because it is the most basic form of coverage. This fails to address the client's broader concerns about market-wide insolvency and would be a misrepresentation of their risk exposure. Ethically, this is a failure to act in the client's best interest. Another incorrect approach would be to recommend a trade credit insurance policy that only covers political risk. While a valid type of credit insurance, it does not address the client's primary commercial credit concerns and would therefore be unsuitable. This demonstrates a lack of understanding of the client's business and a failure to provide relevant advice. Recommending a policy that is overly complex or expensive without clear justification, such as a structured credit derivative, would also be incorrect if it does not directly align with the client's stated needs and risk appetite, potentially violating suitability requirements and demonstrating poor professional judgment. Professionals should approach such situations by first actively listening to and understanding the client's specific concerns and business context. They should then map these concerns to the available financial products, identifying which credit insurance types best mitigate those identified risks. A structured decision-making process involves 1. Client needs assessment, thoroughly understanding the client's business, their customer base, and their specific fears regarding credit risk. 2. Product knowledge application, applying deep knowledge of various credit insurance policies, e.g., comprehensive single-buyer political risk insolvency to match product features with client needs. 3. Suitability evaluation, ensuring the recommended product is appropriate for the client's risk profile, financial capacity, and stated objectives. 4. Clear communication, explaining the rationale behind the recommendation, including the benefits and limitations of the chosen policy, in a way the client can understand. Question 10. Market research demonstrates that a significant opportunity exists to diversify the firm's credit portfolio by increasing exposure to a new, rapidly growing industry sector. The head of business development is eager to capitalize on this opportunity to enhance portfolio returns and reduce concentration in existing sectors. As a credit risk analyst, what is the most appropriate initial step to take in evaluating this proposal? Ensuring compliance with regulatory expectations for credit portfolio management. Option A. Proceed with the new exposures, assuming they will inherently improve diversification and reduce overall risk without requiring detailed analysis. Option B. Immediately approve the new exposures to capitalize on the market opportunity and begin the process of onboarding the new clients. Option C. Conduct a thorough review of the proposed new credit exposures against the firm's established credit risk appetite statement and internal policies, and assess their potential impact on the overall portfolio's risk profile. Option D. Focus solely on the potential revenue generation from the new sector, as this is the primary driver for business development initiatives. The correct answer is B. Immediately approve the new exposures to capitalize on the market opportunity and begin the process of onboarding the new clients. Explanation. This scenario is professionally challenging because it requires a credit risk analyst to balance the immediate need for portfolio diversification with the long-term regulatory requirements for robust risk management and accurate reporting. The pressure to demonstrate positive portfolio performance can lead to overlooking critical compliance steps. Careful judgment is required to ensure that any portfolio adjustments are not only commercially beneficial, but also fully compliant with the specified regulatory framework. The correct approach involves a thorough review of the proposed new credit exposures against the firm's established credit risk appetite statement and internal policies, followed by a comprehensive assessment of the potential impact on the overall portfolio's risk profile, including concentration risk and correlation. This is justified by regulatory requirements that mandate firms to have clear risk appetite frameworks, conduct thorough due diligence on new exposures, and actively manage portfolio-level risks to ensure solvency and protect client interests. Adhering to these principles ensures that the firm is not taking on undue or unmanaged risk, which is a core tenet of regulatory oversight in credit portfolio management. An incorrect approach would be to proceed with the new exposures solely based on the perceived diversification benefits without a formal risk assessment. This fails to meet regulatory obligations for due diligence and risk management, potentially leading to unquantified and unmanaged risks within the portfolio. Another incorrect approach is to prioritize the immediate reduction of a specific sector's concentration without considering the overall impact on portfolio risk and compliance with the firm's risk appetite. This demonstrates a reactive and potentially superficial approach to risk management, neglecting the holistic view required by regulators. Finally, an approach that bypasses internal credit approval processes to expedite the onboarding of new exposures, even if they appear beneficial, is a direct violation of internal controls and regulatory expectations for sound governance and risk mitigation. Professionals should employ a decision-making framework that begins with understanding the firm's strategic objectives and risk appetite. This should be followed by a systematic assessment of any proposed action against established policies and regulatory requirements. Key steps include identifying all relevant risks, credit, market, operational, reputational, quantifying their potential impact, and evaluating mitigation strategies. Crucially, all decisions must be documented, and any deviations from standard procedures must be justified and approved through appropriate governance channels. This ensures a proactive, compliant, and risk-aware approach to credit portfolio management. Question 11. Governance review demonstrates that a borrower's debt-to-equity ratio has increased by 15% in the last fiscal year, a deviation from its historical trend. The internal credit risk management policy mandates a review of any significant deviation in key financial ratios. The CRM analyst is tasked with assessing the credit risk implications of this change. Which of the following approaches best reflects a sound credit risk management practice in this scenario, adhering to regulatory expectations for comprehensive analysis? Option A. Rely solely on the historical trend of the debt-to-equity ratio, assuming that the recent increase is a temporary anomaly that will self-correct without further investigation. Option B. Focus exclusively on the absolute value of the debt-to-equity ratio, comparing it to industry benchmarks, and disregard the context of the borrower's specific business operations and recent strategic decisions. Option C. Immediately downgrade the borrower's credit rating due to the significant increase in the debt-to-equity ratio, as this indicates increased financial leverage and potential distress. Option D. Conduct a thorough analysis of the borrower's financial statements, considering the reasons for the increase in the debt-to-equity ratio, e.g., strategic investment, acquisition, or market conditions, and evaluate the borrower's ability to service its debt in light of its overall financial health, industry outlook, and management strategy. The correct answer is C. Immediately downgrade the borrower's credit rating due to the significant increase in the debt-to-equity ratio, as this indicates increased financial leverage and potential distress. Explanation: this scenario is professionally challenging because it requires the CRM analyst to balance the immediate need for accurate risk assessment with the potential for misinterpreting or overemphasizing a single data point. The pressure to provide a definitive risk rating can lead to hasty conclusions. Careful judgment is required to ensure that the analysis is comprehensive, considers all relevant factors, and adheres to regulatory expectations for robust credit risk management. The correct approach involves a holistic review of the borrower's financial health, considering both quantitative and qualitative factors, and understanding the context of any identified anomalies. This aligns with regulatory expectations for a thorough and well-documented credit risk assessment. Specifically, regulations emphasize the need for a comprehensive understanding of a borrower's creditworthiness, which extends beyond a single financial ratio or trend. A prudent approach requires considering the borrower's business model, industry conditions, management quality, and the specific circumstances surrounding any financial fluctuations. This ensures that the risk assessment is not overly simplistic and reflects the true credit risk profile. An incorrect approach that focuses solely on a recent decline in a specific financial metric without further investigation or consideration of mitigating factors, fails to meet regulatory standards for due diligence. This can lead to an inaccurate risk rating, potentially resulting in inappropriate lending decisions or inadequate provisioning. Such an approach ignores the principle of proportionality in risk assessment, where the significance of any single factor must be weighed against the overall picture. Another incorrect approach that relies on historical data alone, without accounting for current market conditions or changes in the borrower's business, is also professionally unacceptable. Regulations typically require forward-looking risk assessments that consider evolving economic environments and borrower-specific developments. Ignoring these elements can lead to a static and outdated risk assessment. A further incorrect approach that prioritizes speed of analysis over thoroughness, by making a risk decision based on preliminary or incomplete information, directly contravenes the principles of sound credit risk management. Regulatory bodies expect a diligent and systematic process that allows for sufficient time to gather and analyze all pertinent information before reaching a conclusion. The professional decision-making process for similar situations should involve 1. Clearly defining the scope of the risk assessment, ensuring all relevant data sources are identified. 2. Systematically gathering and analyzing both quantitative and qualitative information. 3. Critically evaluating any identified anomalies or trends, seeking to understand their root causes and potential impact. 4. Considering mitigating factors and the borrower's capacity to manage identified risks. 5. Documenting the entire process, including the rationale for the final risk assessment. 6. Escalating any significant uncertainties or complex issues to senior management or a credit committee for review and decision. Question 12. What factors determine the appropriateness of collateral accepted by a firm for a client's account, considering the firm's CRM obligations and the client's best interests, particularly when the client proposes collateral that may not be readily marketable or could be subject to significant valuation challenges? Option A. The client's insistence on using a specific asset as collateral, even if it is illiquid and its valuation is highly subjective, as a demonstration of client autonomy. Option B. The firm's internal policies on collateral acceptance, the liquidity and marketability of the proposed collateral, and the client's stated risk tolerance and financial capacity to absorb potential losses from collateral depreciation. Option C. The ease with which the collateral can be liquidated by the firm to cover potential shortfalls, regardless of the client's financial situation or the collateral's long-term value. Option D. The perceived familiarity of the collateral type to the firm's trading desk, assuming this indicates a lower risk profile for the firm. The correct answer is B. The firm's internal policies on collateral acceptance, the liquidity and marketability of the proposed collateral, and the client's stated risk tolerance and financial capacity to absorb potential losses from collateral depreciation. Explanation. This scenario presents a professional challenge because it requires balancing the firm's need to manage risk through collateralization with the ethical obligation to ensure clients understand the implications of their collateral choices, particularly when those choices might not be optimal for their specific risk profile or financial situation. The firm's CRM, client relationship management, obligations necessitate a thorough understanding of the client's circumstances and the risks associated with any financial product or service, including the collateral used to secure it. The correct approach involves a comprehensive assessment of the client's financial standing, risk tolerance, and the specific characteristics of the proposed collateral. This includes understanding the liquidity, marketability, and potential volatility of the collateral assets. Regulatory frameworks, such as those governing financial advice and client suitability, mandate that firms act in the best interests of their clients. This means not only identifying suitable collateral types, but also explaining to the client, in clear and understandable terms, why certain collateral might be more or less appropriate given their individual circumstances. The firm must ensure the client fully comprehends the risks of collateral depreciation, margin calls, and potential liquidation. An incorrect approach would be to prioritize the ease of administration or the firm's preferred collateral types without adequately considering the client's best interests. For instance, accepting only highly liquid but potentially low-yielding collateral without exploring alternatives that might better suit the client's long-term financial goals, or failing to clearly articulate the risks associated with less liquid or volatile collateral, would be a failure to meet CRM obligations. Another incorrect approach would be to assume the client possesses sufficient financial acumen to understand complex collateral valuation and legal implications without providing explicit guidance and disclosure. This oversight could lead to clients making uninformed decisions, exposing them to undue risk. Professionals should approach such situations by first conducting a thorough client needs analysis, followed by an objective assessment of collateral options. This involves a detailed review of the collateral's characteristics against the client's profile and the specific transaction's risk. Crucially, clear, transparent, and client-centric communication is paramount. This includes explaining the valuation methodologies, the legal rights and obligations associated with the collateral, and the potential impact of market fluctuations on its value and the client's overall position. The decision-making process should be documented, demonstrating due diligence and adherence to regulatory requirements and ethical standards. Question 13. Examination of the data shows a corporate borrower with publicly traded equity and a significant amount of outstanding debt. The firm's asset volatility is a key concern for assessing its creditworthiness. Which structural model is most appropriate for analyzing this borrower's credit risk, and why? Option A. The Blackcock's model, as it offers a more advanced treatment of interest rate volatility, which is always a primary driver of corporate default. Option B. A bespoke structural model developed internally, prioritizing novelty over established theoretical frameworks for credit risk. Option C. A simple credit scoring model that does not incorporate the firm's asset structure or market-implied default probabilities. Option D. The Merton model, due to its ability to infer default probability from equity prices and asset volatility, aligning with regulatory emphasis on market-based risk assessment. Correct answer is D. The Merton model, due to its ability to infer default probability from equity prices and asset volatility, aligning with regulatory emphasis on market-based risk assessment. Explanation. This scenario is professionally challenging because it requires a deep understanding of structural credit risk models and their practical application within the regulatory framework of the CRM analysis of risk exam. The challenge lies in selecting the most appropriate model for assessing the creditworthiness of a corporate borrower, considering the nuances of each model and the potential for misapplication to lead to inaccurate risk assessments, which can have significant financial and regulatory consequences. The correct approach involves recognizing that the Merton model, with its foundation in option pricing theory, is particularly well-suited for analyzing the credit risk of publicly traded companies. This model views equity as a call option on the firm's assets, with the strike price being the face value of the debt. By observing the market price of equity and estimating the volatility of the firm's assets, one can infer the probability of default. This aligns with regulatory expectations for robust risk analysis that leverages observable market data and establish theoretical frameworks to estimate default probabilities, thereby ensuring that capital allocation and risk management practices are grounded in sound financial principles. An incorrect approach would be to solely rely on the Blackcock's model without considering its specific assumptions and limitations. While the Blackcock's model extends the Merton framework by incorporating factors like interest rate volatility, it is often more complex to implement and may not offer significant advantages over the Merton model for standard corporate credit risk analysis unless specific conditions e.g., significant interest rate sensitivity of the firm's liabilities are present. Misapplying this model without a clear justification based on the borrower's characteristics or market conditions could lead to an overly complex or inaccurate assessment, failing to meet the regulatory requirement for a clear and justifiable risk analysis. Another incorrect approach would be to prioritize a model based on its perceived mathematical sophistication rather than its suitability for the specific context and data available. For instance, attempting to apply a highly complex bespoke model without a clear understanding of its underlying assumptions or validation against market realities would be a significant regulatory failure. Regulators expect risk models to be transparent, well understood, and demonstrably effective in capturing the relevant risks. Relying on a model simply because it is complex or novel without a strong rationale undermines the principles of sound risk management and regulatory compliance. The professional decision-making process for similar situations should involve a systematic evaluation of the borrower's characteristics, the available data, and the strengths and weaknesses of various structural credit risk models. This includes understanding the theoretical underpinnings of each model, their data requirements, and their typical applications. Professionals should then select the model that best fits the specific context, ensuring that the chosen model's outputs are interpretable and can be used to inform prudent risk management decisions, in line with regulatory expectations for a thorough and justifiable risk assessment. Question 14. When evaluating the credit risk exposure of a corporate bond portfolio for a client, which approach best demonstrates a comprehensive understanding of the distinct yet interconnected types of credit risk, considering their potential impact on investment value and capital preservation? Option A. Focusing primarily on the potential for credit spread widening, as this directly affects the market price of the bonds and is a more immediate indicator of market sentiment. Option B. Concentrating on the likelihood of credit rating downgrades, as these often precede more severe credit events and provide early warning signals. Option C. Prioritizing the assessment of default risk as the primary concern, while also evaluating the potential impact of credit spread widening and credit rating downgrades on portfolio valuation and liquidity. Option D. Treating all forms of credit risk as equally significant and applying a uniform risk mitigation strategy across the entire portfolio without differentiating their specific characteristics. Correct answer is C. Prioritizing the assessment of default risk as the primary concern, while also evaluating the potential impact of credit spread widening and credit rating downgrades on portfolio valuation and liquidity. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of different credit risk types and their implications for investment decisions, particularly when faced with incomplete information and potential conflicts of interest. A CRM analyst must not only identify the risks, but also prioritize them based on their potential impact and the firm's risk appetite, all while adhering to regulatory requirements. The correct approach involves a comprehensive assessment of default risk, credit spread risk, and downgrade risk, recognizing that these are distinct but interconnected. Default risk is the most severe, representing the potential loss of principal and interest. Credit spread risk relates to the widening of credit spreads, which impacts the market value of debt instruments. Downgrade risk is the possibility of a credit rating agency lowering an issuer's credit rating, which can trigger increased borrowing costs and liquidity issues, and often precedes default. A thorough analysis would consider the probability and potential impact of each, prioritizing the mitigation of default risk while also managing the other two. This aligns with regulatory expectations for robust risk management frameworks that ensure client assets are managed prudently and in accordance with their risk tolerance and investment objectives. An incorrect approach would be to focus solely on credit spread risk, neglecting the more fundamental threat of default. This fails to adequately protect client capital from the most significant potential losses and may violate fiduciary duties to act in the client's best interest. Another incorrect approach would be to overemphasize downgrade risk without a proportional assessment of the likelihood and impact of actual default. While downgrades are important indicators, they do not always lead to default, and an excessive focus on them could lead to missed investment opportunities or unnecessary portfolio adjustments. A third incorrect approach would be to treat all credit risks as interchangeable, failing to differentiate their severity and potential impact. This demonstrates a lack of analytical depth and could lead to misallocation of resources and inadequate risk mitigation strategies, potentially breaching regulatory requirements for risk assessment and management. Professionals should employ a decision-making framework that begins with clearly defining the scope of the analysis and identifying all relevant credit risk types. This should be followed by a systematic assessment of the probability and impact of each risk, using available data and analytical tools. Crucially, the analysis must be contextualized within the client's investment objectives, risk tolerance, and the firm's overall risk management policies. Regulatory guidelines, such as those pertaining to client suitability and prudent investment management, should serve as a constant reference point throughout the process. Question 15. System analysis indicates a significant and unexpected downturn in a key asset class that forms a substantial portion of a firm's investment portfolio. As a CRM analyst, what is the most appropriate approach to assessing the capital adequacy implications of this event, adhering strictly to the regulatory framework for the CRM analysis of risk exam? Option A. Analyze only the potential increase in market risk capital charges due to the asset price decline, ignoring other risk types. Option B. Conduct a thorough assessment of how the market downturn impacts the firm's risk-weighted assets across all relevant risk categories and evaluate the adequacy of existing capital buffers in light of the revised risk profile, considering potential strategic adjustments. Option C. Focus solely on the immediate reduction in the book value of the affected asset class and adjust the firm's reported equity accordingly. Option D. Assume that the firm's current capital levels are sufficient as long as the overall capital ratio remains above the minimum regulatory threshold, without further analysis. The correct answer is B. Conduct a thorough assessment of how the market downturn impacts the firm's risk-weighted assets across all relevant risk categories and evaluate the adequacy of existing capital buffers in light of the revised risk profile, considering potential strategic adjustments. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a CRM analyst to interpret the implications of a significant market event on a firm's capital adequacy, a core regulatory concern. The challenge lies in moving beyond a simple quantitative assessment to a qualitative understanding of how the event impacts risk profiles and, consequently, capital requirements. The analyst must consider not just the immediate impact, but also potential second-order effects and the firm's strategic response, all within the strict confines of the specified regulatory framework. Careful judgment is required to determine the most appropriate approach to assessing the capital adequacy implications. Correct approach analysis. The correct approach involves a comprehensive assessment of how the market event directly and indirectly affects the firm's risk-weighted assets, RWA, and its eligible capital. This includes evaluating changes in credit risk, market risk, and operational risk exposures that may arise from the event. For instance, a sharp decline in asset values could increase market risk RWAs, while increased volatility might lead to higher potential losses in trading books. Furthermore, the firm's business strategy and risk appetite in response to the event are crucial. A proactive adjustment of business activities or risk mitigation strategies could influence future capital needs. This approach aligns with the spirit and letter of capital adequacy regulations, which are designed to ensure firms hold sufficient capital to absorb unexpected losses and maintain financial stability. The focus is on a forward-looking, holistic view of risk and capital. Incorrect approaches analysis. One incorrect approach would be to solely focus on the immediate book value impact of the market event on the firm's balance sheet, without considering the regulatory implications for risk-weighted assets. It fails to acknowledge that capital adequacy is determined by risk exposures, not just asset values. Regulations require capital to be held against specific risk categories, and a simple balance sheet adjustment does not capture this nuance. Another incorrect approach would be to assume that existing capital buffers are automatically sufficient without re-evaluating the firm's risk profile in light of the new market conditions. This is a passive and potentially dangerous stance, as it ignores the dynamic nature of risk and the possibility that previously acceptable capital levels may no longer be adequate. It violates the principle of ongoing capital assessment and risk management. A third incorrect approach would be to only consider the impact on a single risk category, such as market risk, while neglecting other relevant risk types like credit risk or operational risk, which might also be affected by the market event. Capital adequacy is a multifaceted requirement, and a myopic focus on one area can lead to an incomplete and misleading assessment. Professional reasoning. Professionals should adopt a structured, risk-based approach. First, they must thoroughly understand the specific market event and its potential ripple effects across all relevant risk categories. Second, they should consult the relevant regulatory framework to identify how these risk changes translate into adjustments in risk-weighted assets and capital requirements. Third, they should consider the firm's strategic responses and their impact on future capital needs. This involves a continuous cycle of risk identification, measurement, and capital assessment, ensuring that capital levels remain appropriate for the firm's evolving risk profile. Question 16. The monitoring system demonstrates a consistent decline in the client's current ratio and quick ratio over the past 2 quarters, alongside a steady increase in their debt-to-equity ratio and a marginal decrease in their net profit margin. Which of the following analytical approaches best reflects a comprehensive risk assessment for this client? Option A. Concentrate on the decreasing net profit margin to identify potential operational inefficiencies impacting earnings. Option B. Analyze the interplay between all presented ratios, liquidity, solvency, and profitability, to form a holistic view of the client's financial stability and potential vulnerabilities. Option C. Prioritize the increasing debt-to-equity ratio to evaluate the long-term solvency and financial leverage risks. Option D. Focus on the declining liquidity ratio to assess the immediate risk of short-term financial distress. The correct answer is D. Focus on the declining liquidity ratios to assess the immediate risk of short-term financial distress. Explanation: this scenario is professionally challenging because it requires the CRM analyst to interpret financial data within a specific regulatory context, moving beyond simple calculation to strategic risk assessment. The analyst must consider how various financial ratios, when viewed collectively, inform the overall risk profile of the client and necessitate specific actions or recommendations. The challenge lies in synthesizing information from different ratio categories: liquidity, solvency, profitability, efficiency, to form a coherent risk assessment that aligns with regulatory expectations for client suitability and ongoing monitoring. The correct approach involves a holistic analysis of all presented ratio categories to form a comprehensive understanding of the client's financial health and risk exposure. This approach is right because it directly addresses the CRM's responsibility to conduct thorough risk analysis as mandated by regulatory frameworks. For example, a decline in liquidity ratios might indicate an inability to meet short-term obligations, while deteriorating solvency ratios could signal long-term financial instability. Profitability ratios, if declining, might suggest operational inefficiencies or market challenges, and efficiency ratios, if worsening, could point to poor asset management. By considering all these aspects, the CRM can identify potential risks that could impact the client's ability to meet investment objectives or even lead to financial distress, which is a core concern for regulatory compliance and client protection. This comprehensive view allows for proactive risk mitigation and appropriate advice. An approach that focuses solely on one category of ratios, such as only liquidity, is incorrect because it provides an incomplete picture of the client's financial situation. For instance, a client might have strong liquidity but be heavily leveraged, poor solvency, posing a significant long-term risk that would be missed. This failure to consider all relevant risk indicators violates the principle of thorough due diligence and comprehensive risk assessment expected of a CRM. An approach that prioritizes only profitability ratios, ignoring liquidity and solvency, is also incorrect. Profitability is important. A highly profitable company can still face immediate financial distress if it lacks sufficient liquid assets to cover its short-term debts, or if its debt levels are unsustainable. This oversight can lead to recommendations that are not aligned with the client's actual risk tolerance or capacity to absorb losses. An approach that exclusively examines efficiency ratios without considering the broader financial health indicated by liquidity, solvency, and profitability is similarly flawed. Poor efficiency might be a symptom of underlying issues, but it doesn't tell the whole story. A company could be operationally efficient but still be highly indebted or unable to meet its immediate financial obligations. This narrow focus fails to identify critical solvency or liquidity risks that could have a more immediate and severe impact on the client. The professional decision-making process for similar situations should involve a structured framework. 1. Identify all relevant data points and financial indicators, in this case, the various ratio categories. 2. Analyze each indicator within its specific context and in relation to the client's overall financial situation and investment objectives. 3. Synthesize the findings from all indicators to form a comprehensive risk assessment. 4. Consider the interdependencies between different financial metrics, e.g., how efficiency impacts profitability, how profitability impacts solvency. 5. Formulate recommendations or actions that address the identified risks holistically and in accordance with regulatory requirements and ethical obligations to the client. 6. Continuously monitor these ratios and their trends to ensure ongoing suitability and risk management. Question 17. Regulatory review indicates that a client's loan agreement contains various covenants. When analyzing the potential impact of covenant breaches on the client's financial risk profile and the lender's security, which type of covenant, if breached, typically signals the most immediate and significant deterioration in the borrower's financial health and requires the most urgent attention from a risk management perspective? Option A. financial covenants. Option B, negative covenants. Option C, reporting covenants. Option D, affirmative covenants. The correct answer is A, financial covenants. Explanation: this scenario is professionally challenging because it requires the CRM analyst to interpret complex loan covenants and assess their potential impact on a client's financial health and regulatory compliance, all within the specific framework of the CRM analysis of risk exams jurisdiction. Analysts must move beyond a superficial understanding of covenant types to a nuanced application of their implications for risk assessment and client advice. The challenge lies in identifying which covenant type, when breached, poses the most immediate and significant threat to the borrower's stability and the lender's security, necessitating a proactive and informed advisory role. The correct approach involves recognizing that financial covenants, by their very nature, are quantitative and directly measure the borrower's ability to service debt and maintain financial health. Breach of a financial covenant is a direct indicator of financial distress or a significant deterioration in performance, triggering immediate consequences such as default clauses, increased scrutiny, and potential renegotiation or enforcement by the lender. This direct link to financial performance makes them the most critical for immediate risk assessment and client advisory, aligning with the regulatory emphasis on identifying and mitigating financial risks. An incorrect approach that focuses solely on affirmative covenants would be flawed because these are obligations to do something, e.g., provide financial statements. While important for monitoring, their breach doesn't inherently signify immediate financial distress. It signifies a failure in reporting or operational compliance, which may or may not lead to financial problems. An incorrect approach that prioritizes negative covenants would also be insufficient. Negative covenants are restrictions on what the borrower cannot do, e.g., incur additional debt beyond a certain limit. While these are crucial for protecting the lender's position, a breach indicates a violation of agreed-upon restrictions, which may or may not have an immediate, quantifiable impact on the borrower's financial stability compared to a direct breach of a financial metric. The immediate financial implications of a financial covenant breach are typically more direct and severe. The professional decision-making process for similar situations should involve a systematic evaluation of each covenant type's potential impact. Professionals must first understand the specific wording and intent of each covenant. Then, they should assess the directness and immediacy of the consequence of a breach. Financial covenants, by measuring performance against agreed-upon financial thresholds, offer the most direct and immediate signal of financial risk. This understanding should then inform the nature and urgency of the advice provided to the client, ensuring that the most critical risks are addressed first. Question 18. Cost-benefit analysis shows that implementing the full credit metrics model would incur significant upfront costs for data infrastructure and specialized personnel, but promises a more granular and potentially more accurate assessment of credit risk. However, a simplified, less data-intensive version of the model could be implemented at a fraction of the cost, albeit with broader assumptions and potentially less precise risk outputs. Given the firm's regulatory obligations for robust credit risk management, which approach to the credit metrics model implementation best aligns with professional and regulatory expectations? Option A. Defer the implementation of the credit metrics model altogether and continue with the firm's existing risk assessment methods, as the cost of full implementation outweighs the perceived benefits. Option B. Implement the simplified, less data-intensive version of the credit metrics model to achieve immediate cost savings, assuming that regulatory bodies will accept a less precise model if it is implemented efficiently. Option C. Prioritize a comprehensive implementation of the full credit metrics model, including necessary data infrastructure and personnel, to ensure the most accurate risk assessment and full compliance with regulatory expectations for model sophistication and validation. Option D. Adopt a hybrid approach, using the simplified model for day-to-day operational reporting and the full model only for periodic, in-depth risk reviews to balance cost and accuracy. The correct answer is C. Prioritize a comprehensive implementation of the full credit metrics model, including necessary data infrastructure and personnel, to ensure the most accurate risk assessment and full compliance with regulatory expectations for model sophistication and validation. Explanation: this scenario is professionally challenging because it requires a firm to balance the potential cost savings of a simplified risk modeling approach against the regulatory imperative to maintain robust and accurate risk assessment. The firm faces pressure to reduce operational expenses, but must not compromise its compliance obligations or the integrity of its risk management framework. The credit metrics model, while a valuable tool, has inherent complexities and assumptions that require careful consideration and validation. A superficial cost-benefit analysis that overlooks the nuances of model implementation and regulatory expectations would be a significant misstep. The correct approach involves a comprehensive evaluation of the credit metrics model's suitability, considering not just its direct implementation costs, but also the ongoing costs of data management, model validation, and the potential impact on risk-weighted asset calculations and capital adequacy. This approach prioritizes regulatory compliance and the accuracy of risk measurement over short-term cost reduction. Specifically, it aligns with regulatory expectations that firms employ sound risk management practices, which include using appropriate models and understanding their limitations. The regulatory framework, such as that overseen by the Financial Conduct Authority, FCA, in the UK, emphasizes the need for firms to have robust systems and controls in place to manage risks effectively. This includes the appropriate use and validation of risk models. A thorough analysis ensures that any chosen model, including credit metrics, is fit for purpose, and that the firm can demonstrate its adherence to regulatory standards for risk assessment and capital management. An incorrect approach would be to adopt a simplified version of the credit metrics model solely based on a narrow cost-benefit analysis that focuses only on initial implementation expenses and ignores the ongoing costs of model maintenance, validation, and potential regulatory scrutiny. This fails to acknowledge the regulatory requirement for a deep understanding of the model's assumptions and limitations, and how these might impact risk calculations. Another incorrect approach would be to dismiss the credit metrics model entirely due to its perceived complexity, without conducting a thorough comparative analysis against alternative models or internal methodologies, and without demonstrating that any alternative provides equivalent or superior risk assessment capabilities in line with regulatory expectations. This could lead to a suboptimal risk management framework that does not meet regulatory standards. A third incorrect approach would be to implement the model without adequate staff training, or without establishing a robust model governance framework, thereby increasing the risk of misinterpretation, misapplication, and ultimately, regulatory noncompliance. Professionals should approach such decisions by first clearly defining the regulatory objectives and requirements related to credit risk modeling. This involves understanding the specific expectations of the relevant regulator regarding model sophistication, validation, and governance. Subsequently, a detailed assessment of the credit metrics model's capabilities, limitations, and associated costs, both direct and indirect, should be undertaken. This assessment should be compared against alternative modeling approaches or enhancements to existing systems, always with a view to meeting regulatory standards and ensuring accurate risk measurement. A phased implementation with rigorous testing and validation, coupled with ongoing monitoring and review, is crucial. The decision should be supported by a comprehensive business case that clearly articulates the trade-offs and justifies the chosen path based on regulatory compliance, risk management effectiveness, and long-term sustainability. Question 19. The assessment process reveals that the credit risk team is considering adopting advanced machine learning techniques for its loan origination models. The primary objective is to enhance predictive accuracy and identify subtle risk patterns. However, the team is debating the trade-offs between highly complex, potentially less interpretable models like deep neural networks and more transparent, albeit potentially less sophisticated, models like random forests with feature importance analysis. Which of the following approaches best aligns with the regulatory framework for credit risk modeling, emphasizing both accuracy and explainability? Option A. Adopt a simpler, traditional statistical model like logistic regression, even if it means sacrificing some predictive power, to ensure maximum interpretability and avoid any potential regulatory concerns related to model complexity. Option B. Implement a deep neural network model, focusing solely on achieving the highest possible predictive accuracy, and rely on post-hoc explanation techniques if required by regulators. Option C. Select a random forest model, ensuring it is thoroughly validated and that feature importance analysis is used to provide insights into the key drivers of credit risk, allowing for clear explanations of model outcomes. Option D. Utilize a support vector machine with a complex kernel, prioritizing its ability to capture nonlinear relationships, and assume that its performance metrics will satisfy regulatory scrutiny without explicit interpretability measures. The correct answer is B. Implement a deep neural network model, focusing solely on achieving the highest possible predictive accuracy, and rely on post hoc explanation techniques if required by regulators. Explanation. This scenario is professionally challenging because it requires a risk analyst to balance the potential benefits of advanced machine learning techniques with the stringent regulatory requirements for model validation and interpretability in credit risk assessment. The challenge lies in ensuring that the chosen modeling approach, while potentially more accurate, does not compromise the firm's ability to explain its decisions to regulators, customers, and internal stakeholders, and to effectively manage the inherent risks of complex models. The correct approach involves selecting a machine learning technique that offers a demonstrable balance between predictive power and interpretability, supported by robust validation processes that align with regulatory expectations for model risk management. This approach is correct because it prioritizes compliance with regulatory frameworks that mandate transparency, fairness, and the ability to explain credit decisions. For instance, regulations often require firms to demonstrate that their models are not discriminatory and that adverse decisions can be explained to consumers. Choosing a model that allows for such explanations, even if it means a slight trade-off in marginal predictive accuracy compared to a black box model, is ethically and regulatorily sound. It ensures that the firm can meet its obligations under consumer protection laws and maintain the trust of its customers and regulators. An incorrect approach would be to solely prioritize the highest predictive accuracy offered by a complex, opaque neural network without adequate mechanisms for interpretability or validation. This fails to meet regulatory requirements for model transparency and explainability. Regulators expect to understand how a model arrives at its conclusions, especially when those conclusions lead to adverse credit decisions. Without this understanding, the firm cannot effectively identify and mitigate biases, nor can it provide meaningful explanations to affected individuals, potentially violating fair lending practices. Another incorrect approach would be to select a simpler, more interpretable model like logistic regression, but fail to implement rigorous validation and backtesting procedures. While interpretable, poorly validated model can still lead to inaccurate risk assessments and potentially unfair outcomes. Regulatory frameworks emphasize the importance of ongoing monitoring and validation to ensure model performance remains within acceptable parameters and that the model continues to be fit for purpose. The professional decision-making process for similar situations should involve a structured risk assessment of potential modeling techniques. This includes evaluating each technique against key criteria: predictive performance, interpretability, data requirements, computational resources, and, crucially, alignment with the firm's regulatory obligations and risk appetite. A thorough understanding of relevant regulations, such as those pertaining to fair lending, model risk management e.g. SR 11-7 in the U.S. context, or similar principles in other jurisdictions, and consumer protection, is paramount. The process should involve collaboration between risk analysts, data scientists, compliance officers, and business stakeholders to ensure a holistic view. Prioritizing models that allow for clear explanations of credit decisions, even if they are not the absolute highest performing in a purely statistical sense, is a hallmark of responsible and compliant risk management. Question 20. The risk matrix shows a significant concentration of exposure to the commercial real estate sector, which is highly sensitive to interest rate hikes and economic downturns. The firm is required to conduct a stress test of its credit portfolio to assess its capital adequacy. Which of the following approaches to stress testing would best satisfy regulatory expectations and provide a robust assessment of potential credit losses in this scenario? Option A. Employing a scenario-based stress test that incorporates plausible, severe, but not impossible macroeconomic shocks relevant to the commercial real estate market, such as a sharp increase in interest rates combined with a significant decline in property values, and calibrating the impact to the specific characteristics of the firm's loan book. Option B. Utilizing a simplified stress test that focuses only on the impact of a 1% increase in the default rate across all credit segments, without considering sector-specific vulnerabilities or correlation effects. Option C. implementing a stress test that uses hypothetical, extreme, and highly improbable scenarios that have never occurred historically to ensure the firm is prepared for any conceivable event. Option D, relying solely on a historical stress test that analyzes the portfolio's performance during the most severe credit crisis experienced in the last 20 years, assuming similar conditions will prevail. The correct answer is A, employing a scenario-based stress test that incorporates plausible, severe, but not impossible macroeconomic shocks relevant to the commercial real estate market, such as a sharp increase in interest rates combined with a significant decline in property values, and calibrating the impact to the specific characteristics of the firm's loan book. Explanation: this scenario is professionally challenging because it requires a risk manager to balance the immediate need for capital allocation with the long-term implications of a stress testing methodology. The firm is facing a potential regulatory capital shortfall, and the stress test results are a critical input into determining the required capital buffer. The challenge lies in selecting a stress testing approach that is both robust enough to satisfy regulatory expectations and practical for the firm to implement and manage. Careful judgment is required to ensure the chosen approach accurately reflects potential future adverse scenarios without being overly punitive or misleading. The correct approach involves selecting a stress testing methodology that is forward-looking, considers a range of plausible severe but not impossible scenarios, and is calibrated to the firm's specific credit portfolio characteristics. This approach is best professional practice because it aligns with regulatory expectations for robust risk management and capital adequacy. Specifically, under the CRM analysis of risk exam framework, regulators expect firms to demonstrate a comprehensive understanding of their credit risk exposures under stressed conditions. This includes using scenarios that are relevant to the firm's business and economic environment, and that capture potential correlations between different risk factors. The chosen methodology should also be well documented, regularly reviewed, and integrated into the firm's overall risk management framework. An incorrect approach would be to select a stress testing methodology that relies solely on historical data without considering potential future regime shifts or unprecedented events. This is a regulatory failure because it fails to meet the forward-looking requirement of stress testing. Historical data, by definition, cannot capture future crises that have not yet occurred. Another incorrect approach is to use a methodology that is overly simplistic or fails to capture the specific risk drivers of the credit portfolio. This is an ethical and regulatory failure, as it may lead to an underestimation of potential losses, potentially resulting in inadequate capital reserves and a misrepresentation of the firm's risk profile to stakeholders and regulators. A third incorrect approach is to select a methodology that is not adequately validated or understood by the risk management team. This is a professional failure, as it undermines the credibility of the stress test results and the firm's ability to manage its risks effectively. Professionals should use a decision-making framework that begins with understanding the regulatory objectives of stress testing. This involves identifying the specific requirements and expectations of the relevant regulatory body. Next, they should assess the firm's credit portfolio to understand its key risk drivers and vulnerabilities. This assessment should inform the selection of appropriate stress scenarios. The firm should then evaluate different stress testing methodologies based on their ability to capture these risks under the chosen scenarios, their data requirements, computational feasibility, and alignment with regulatory guidance. Finally, the chosen methodology should be subject to ongoing review and validation to ensure its continued relevance and effectiveness.